Okay, let's unpack this. Coursera.
Yeah.
From, what, a 33-door IPO down to under $9 recently, now hovering around $8.76. That's, well, a dizzying drop.
It really is.
And with a year that saw its stock swing between just over $5 and $12 and a 35% decline overall, you have to wonder, is the market just having one of its moments, or is something more fundamental going on with this online learning platform?
That kind of volatility definitely makes you, want to dig deeper. Coursera connects a massive number of learners with some of the best educational institutions and companies in the world. A stock performance like that suggests we really need to take a closer look at what's happening under the surface.
Exactly. For this deep dive, we've compiled what we're calling a Coursera Deep Stock Analysis as of today, April 27th, 2025. Our mission is to really understand Coursera's engine, how it generates revenue, the people steering the ship, its financial well-being, and what the market's current take is. We want to provide you with a clear, thorough understanding of whether this current valuation might be a long-term opportunity without getting lost in, all the financial jargon.
Yeah, cut through the noise.
And you can find all the sources we use linked in the description below, by the way.
Good stuff. We're aiming to give you the essential insights, so how are we going to tackle this?
Okay, we'll break this down into two halves. In the first, we'll explore the core of Coursera's operations. Its business model, how it actually works and makes money, the services it provides, its position in the broader market, the competitive landscape, the advantages it holds, the management team leading the company, and its overall financial health.
Okay, makes sense. Business, management, financials first.
Then, in the second half, we'll shift our focus to market sentiment, how investors and analysts are perceiving the stock, any significant recent news, and some of the trading dynamics.
Like short interest and options.
Exactly. We'll also examine who the major owners of the company are, assess the key risks Coursera is facing, including those recently imposed U.S. tariffs, and then bring it all together with a brief conclusion and a final thought to leave you with.
Sounds like a solid roadmap. Ready to jump in?
Let's do it. Chapter 1, Business Understanding. At its core, Coursera operates what's called a three-sided marketplace. Can you maybe explain what that means in simple terms?
Yeah, sure. Think of it like a meeting place. On one side, you have learners, people wanting new skills, right?
Okay.
Then you have educators, top universities, companies like Google, IBM, Microsoft offering the actual courses and certificates.
The content provider.
Exactly. And the third side is organizations, companies looking to hire skilled people or, upskill their own workforce.
Yeah.
Coursera is the platform connecting all three.
Got it. And it uses a freemium strategy, right? Like lots of free stuff to get people in the door. How does that actually make money for Coursera?
Precisely. That free content is like a massive magnet. It's attracted over, 175 million registered learners by last quarter? Huge numbers.
Wow.
So Coursera then makes money from this huge user base in a few main ways. For individual learners, they charge fees for things like getting a certificate when you finish a course, or for completing a specialization, which is a series of related courses.
Okay.
And those professional certificates from big tech companies, those are a big draw too. Plus, there's Coursera Plus, that's their subscription, gives you access to a lot of the catalog for a flat fee.
How much is that again?
Currently, it's $59 a month or $399 a year. And in Q1 2025 alone, this whole consumer segment, which interestingly now includes degrees revenue under their new reporting,
All right.
that brought in $117.6 million.
So the full bachelor's and master's degree programs are now just lumped into the consumer revenue. That does seem like an interesting shift in how they present things. What about the other revenue streams?
Well, the enterprise segment is the other big one. That's Coursera for Business or Coursera for Teams. This is where companies, governments, even universities pay for tailored learning programs for their people.
Right, corporate training, essentially.
Yeah, basically. That segment pulled in $61.7 million in Q1 2025, and it's been growing pretty steadily. And if we look back at the old reporting structure, just the degree segment on its own brought in $15.5 million that same quarter. Coursera gets a cut from the universities offering those degrees through the platform.
Okay, so multiple income streams. Now, when we talk about what Coursera actually offers, it's a pretty wide range, isn't it? Not just full courses.
Oh, absolutely. They've got the whole spectrum, from really short stuff like clips and guided projects for, quick skill building.
Like bite-sized learning.
Exactly. All the way up to individual courses, more in-depth specializations, and those professional certificates we mentioned, which are really valuable in the job market. Then you have master track certificates, which are like chunks of master's degrees, and of course the full bachelor's and master's programs themselves.
And the subscription, Coursera Plus.
Right, Coursera Plus. And for businesses, Coursera for Business and Teams, which now has some cool AI-assisted features, and these things called academies for focused training. Plus, they even have Coursera Coach, which is an AI helper for learners within courses.
Sounds like learners can really kind of build their credentials over time, almost like stacking blocks. Start small, build up.
That stackable idea is definitely a key part of their appeal. It gives people clear paths, Start with a course, maybe get a certificate, work towards a specialization, maybe even get credit towards a full degree down the line. It's about continuous learning.
Makes sense. Now let's talk about the sheer size and reach. The numbers are pretty impressive.
They really are. Over 175 million registered learners. And they added a record 7 million just in Q1.
Wow.
Partnering with over 350 universities and industry leaders, more than 1,600 enterprise clients, and nearly 10,000 courses in the catalog, it's genuinely a massive global platform.
So what's the fundamental appeal? Why are all these different groups, learners, educators, companies flocking to Coursera?
Well, the core value prop really boils down to access, making high-quality, flexible, affordable, and importantly, job-relevant education accessible to pretty much anyone, anywhere.
Right.
For learners, it's obvious. Skills, career advancement, personal growth from top names on their own schedule. For the universities and companies, it's expanding their reach globally, leveraging Coursera's tech.
And for businesses.
It's a cost-effective, scalable way to upskill their workforce with the skills they actually need right now.
Okay, good handle on the business itself. Now let's zoom out a bit. The industry it operates in, ed tech. What does that broader landscape look like? Seems huge.
Oh, it's enormous and growing fast. If you look at the forecast for 2025, depending on who you ask, the estimates range from like $187 billion up to over $400 billion.
Huge range, but big numbers either way.
Exactly.
Yeah.
And projections out to 2030 suggest it could hit close to $550 billion, with compound annual growth rates somewhere in the 13–14% range.
So what's driving all that growth? Why is ed tech booming?
Several big trends are pushing it. The whole digital transformation of education is key, obviously accelerated by, well, recent events.
Right, the pandemic effect.
For sure. Then there's this massive ongoing need for upskilling and reskilling. Think about AI. The demand for AI courses has just exploded.
Makes sense.
Employers are also focusing more on job-relevant credentials, not just traditional degrees. AI itself is getting baked into platforms for personalization. Plus, online learning just breaks down geographical barriers, making education global, and people want learning tailored to them.
Where's the biggest market?
North America is currently the largest, but the Asia-Pacific region is actually the fastest growing. Lots of potential there.
It definitely sounds like a market with a lot of opportunity. But that usually means a lot of competition too, right? Who are Coursera's main rivals?
Yeah, the competitive landscape is, let's say, diverse and crowded. You've got direct competitors like AEX, which is part of 2U. Now they also partner with universities and offer degrees.
Okay.
Then there are broad marketplaces like Udemy, which has a staggering number of courses, often from individual instructors, over 210,000.
Well,
Platforms focus more on professional development, think LinkedIn Learning, Udacity, Pluralsight. They're big players too. And then niche platforms like Skillshare for creative skills or Khan Academy for free foundational stuff, plus companies like Chegg, Blackboard, Stride, Adtalem. It's a busy space.
so a really wide mix. What is it that makes Coursera stand out? What's their special sauce, so to speak?
I'd say Coursera's key differentiator really comes back to those strong established partnerships with top-tier universities and big industry names.
Like the Googles and IBMs?
Exactly. That lets them offer recognized, often accredited credentials and highly valued certificates. That gives them a definite edge over platforms that are more open or maybe just focused on vocational skills.
Now, operating globally in education must come with a ton of regulations.
Yeah.
What's that environment like? It must be complex.
Oh, you're absolutely right. It's a complex web. Data privacy is huge.
Yeah.
You've got FERPA in the US, COPPA for kids privacy, GDPR in Europe.
Right, the alphabet soup.
Pretty much. Then there's accreditation, making sure programs are legit. And state authorization in the U.S. if you're offering programs across state lines online. Digital accessibility, like ADA compliance, is crucial too. And internationally, you add varying tax laws, export controls. It's a significant operational burden and a constant compliance risk.
All those rules must make it tough for new companies to just jump in. What are the main barriers to entry here?
There are definitely some substantial ones. Building brand recognition and trust in education, that takes serious time and money.
Yeah, you don't trust your education to just anyone.
Exactly. And replicating Coursera's network of hundreds of top universities and companies, that's incredibly hard to do quickly. The sheer scale of their content, nearly 10,000 courses, is another huge barrier.
And the tech platform itself.
Right. Developing and maintaining that sophisticated platform with AI, global reach, that requires ongoing, significant investment. Then there's the existing learner base, millions strong. That creates powerful network effects.
How so?
Well, more learners attract more great partners and content, which in turn attracts more learners. It's a virtuous cycle. Plus, you need deep pockets to fund all this and navigate those regulations we just talked about.
So putting it all together, what would you say are Coursera's main competitive advantages? Their economic moat, if you like.
Coursera's built a pretty decent moat, I think. Their brand strength, tied to those prestigious partners, is huge. They also benefit from cost advantages. The scale of their digital platform helps there.
Economies of scale.
Right. The network effects we just mentioned are powerful. There are also switching costs for learners invested in the platform, for companies using it for training, even for the partner institutions.
It's fancy, you don't want to switch easily.
And finally, they have unique assets. Those exclusive partnerships, their proprietary tech and learning data, that massive global user base, and interestingly, their public benefit corporation and B Corp status, which resonates with some people.
Okay, that gives us a really solid grasp of the business side. Let's shift gears to Chapter 2. Management evaluation. Who's actually running the show?
Yeah, leadership is critical, especially with the recent changes. Greg Hart took over as CEO on February 3rd this year, replacing Jeff Maggiancalda.
Right, Maggiancalda led them through the IPO. What's Hart's background?
Hart's got over 25 years under his belt, mostly at Amazon, actually. He was key in developing Alexa and Prime Video.
Wow, okay. Relevant experience.
Very relevant. He was also COO at Compass, focusing on efficiency and hitting positive free cash flow. Sits on the Bose board, holds a ton of patents. His stated focus for Coursera is on value, innovation, access, and growth, particularly mentioning Coursera for Campus as a priority for 2025. His background seems like a good fit for Coursera's current needs, focusing maybe less on pure growth and more on efficiency and innovation.
So potential shift in strategy, perhaps. What about the financial leadership?
The CFO is Ken Han. He joined back in June 2020, so he's seen the company through the IPO and, importantly, helped steer them towards achieving positive adjusted EBITDA and free cash flow last year in 2024. He's got a lot of CFO experience in tech.
The co-founder, Dr. Andrew Ng, is he still involved?
Oh, yes, definitely. Dr. Ng is still chairman of the board. He remains a really important strategic voice, especially given his deep expertise in AI and online education. He's a pioneer in the field.
How has this management team, including the previous CEO, handled challenges in the past?
Well, they certainly showed adaptability during the pandemic, scaling up rapidly to meet that surge in demand.
Right.
More recently, facing slowing growth, they took action cost reductions and that CEO transition we just discussed. It shows they're willing to make tough calls when needed.
And how do they communicate with investors? Are they pretty transparent?
They seem to follow the standard playbook for public companies. Regular earnings calls, presentations, SEC filings. They do use non-GAAP metrics, which is common, but they provide the reconciliations back to GAAP.
Okay.
And interestingly, I saw a recent job posting for an investor relations manager that really emphasized clear communication, so it seems to be something they're actively focused on.
Coursera also has that unique status, public benefit corporation, B Corp certified. How does that play into their reputation and management decisions?
That's a really key part of their identity. Being a PBC means their board legally has to balance shareholder financial interests with their stated public benefit, providing global access to education, and also consider other stakeholders like learners and employees.
So it's not just about profit.
Exactly. It's a formal commitment. And the B Corp certification is like an independent stamp of approval that they meet high social and environmental standards. They even offer courses on ethical leadership. It means management constantly has to weigh this broader mission against purely financial goals.
Okay, moving on to how Coursera actually uses its money. Chapter 2.2, capital allocation. Where have they been putting their resources?
Historically, a lot of it went back into fueling growth R&D, especially in AI lately, getting more content, sales, and marketing.
It makes sense for a growing company.
Yeah. More recently, though, the focus seems to be prioritizing investments in the consumer and enterprise parts of the business, including that Coursera for Campus push, likely aiming for quicker returns. We haven't really seen any major M&A activity from them lately.
But they did start buying back shares last year, right?
Yes, they did. In 2024, they launched a $95 million share buyback program. The main stated reason was to offset the dilution from stock compensation given to employees.
So not necessarily a sign they think the stock is super cheap, but more about managing share count.
That was the official line, yes. It could signal a bit of a shift towards shareholder returns, but they still don't pay any dividends, and there's no sign they plan to start anytime soon.
Okay. Now, a really crucial metric for judging capital use is return on invested capital, or ROIC. How does Coursera look there?
Yeah, this is definitely an area of concern. Their ROIC has been consistently negative for years. We're talking figures like negative 13% down to maybe negative 38% in some periods. The annualized number for Q4 2024 was around negative 29.1%.
And how does that compare to their cost of capital?
It's well below their estimated WACC, which is probably somewhere in the 10.3% to 12.5% range. So basically, the investments they've been making haven't been generating returns high enough to even cover the cost of the capital used.
Which means value destruction, essentially.
During those periods, yes, it aligns with their history of GAAP net losses. Getting that ROIC above their WACC consistently is a really critical hurdle for them to prove they can create long-term value. It's kind of ironic they actually offer courses on ROIC.
Huh, interesting. Okay, that negative ROIC is definitely a flag. Let's transition to Chapter 3, financial health.
Right.
What do the key metrics tell us right now?
All right, financials. As of late April 2025, market cap is around $1.41 billion. The forward PE ratio, based on analyst estimates for this year's earnings, is about 23.7.
But the trailing PE,
Not applicable because they've had net losses historically. Now, revenue growth. That's where you see the slowdown clearly. It went from a huge 60% in 2020, down progressively. Q1 2025 was just 6% year-over-year growth.
only 6%. Wow. And their forecast for the full year?
Their guidance for fiscal 25 is between $720 and $730 million in revenue. That's only about 4-5% growth at the midpoint. A significant deceleration.
That is a major slowdown. What about profitability then? Are they making money on that revenue?
Well, their gross margins are decent, around 53-54% on a GAAP basis over the last year. But operating margins are still negative under GAAP, though they are improving.
But they talk about positive adjusted EBITDA.
They do, and they've achieved that. It was 6.0% for the full year 2024, and actually jumped to 10.4% in Q1 2025, which is encouraging. Net income is still negative under standard GAAP accounting, but again, the losses are narrowing.
What about non-GAAP net income?
On a non-GAAP basis, which excludes things like stock-based compensation, they are profitable. 8.0% margin in 2024 and 11.0% in Q1 2025.
Okay, so profitable by some measures, but not yet consistently on the standard GAAP basis.
Yeah.
What of the balance sheet? Financial stability.
Their balance sheet is actually a major plus. They have almost no traditional debt. Debt to equity is near zero.
That's good.
And they're sitting on a huge pile of cash, over $700 million in cash and equivalents. Free cash flow has also turned positive, and it's growing. Likely over $60 million in the last 12 months, up significantly from just $7.9 million in 2023.
Any other balance sheet metrics?
Price to book is around 2.25. Price to sales about 2.0 based on trailing revenue.
That large cash cushion must give them a lot of flexibility, right? What's the overall picture of stability look like?
Yeah, that cash is key. Looking longer term, they've had consistent GAAP net losses from 2020 to 2024, though, as we said, they're shrinking. Non-GAAP profitability is only a recent thing, starting in 2024.
Dividends.
No dividends paid, none expected. Debt management isn't an issue at all, given the low debt. Liquidity looks healthy, current ratio over 2.0, and that positive FCF trend suggests they're getting better at managing working capital. Overall, the strong cash position and minimal debt are definite strengths, giving them options. All right, let's switch gears now to the second half, Chapter 4, Market Sentiment. How are investors and analysts actually feeling about Coursera these days?
Well, just look at the stock chart, right? That huge drop from the IPO price and the negative performance over the last year. It screams caution, maybe even negativity from the market overall.
Yeah, hard to argue with that.
The lack of consistent GAAP profits and that slowing revenue growth we just talked about are almost certainly the main culprits weighing things down.
Agreed. But it's interesting when you compare that to what Wall Street analysts are saying. The consensus rating is actually still a buy, believe it or not.
Really? Even with that stock performance?
Yeah, but it's definitely a tempered buy. Price targets have come down a lot over the past year. The average target now is around $9.55, but there's a huge range, some as low as $7, others up around $12.60.
So analysts are still somewhat positive, but not exactly united.
Not at all. You've got recent buy ratings from Morgan Stanley, Needham, Telsey, but then JP Morgan and Bank of America are at hold or sell with $7 targets. It shows a real lack of conviction across the board, despite the overall buy average.
That divergence is interesting. What recent news might have swayed sentiment one way or the other?
Well, the Q1 earnings report in late April was definitely a positive. They beat expectations on revenue and non-GAAP EPS, reported that record 7 million new learners, and even nudged up their revenue guidance for the year.
How did the market react to that?
The stock jumped over 12% the next day. So that was clearly well received. Earlier in the year, the CEO transition announcement, Hart replacing Meghan Calda, caused some short-term volatility, but Hart's background seems generally seen as a positive now.
What about some of the more technical market indicators, like short interest? Are people betting against the stock?
There's some short interest, yeah. Around 6.4 million shares shorted, which is about 4.7% of the float. The days to cover is around 4 or 5 days. I'd call that moderate, not extreme, but definitely shows some bearish bets out there.
And options activity.
Looking at options, the put-call ratio is actually below 1.0, meaning slightly more open call options than puts. That could suggest maybe some bullish speculation or maybe just hedging. Implied volatility is quite high, though, over 70%.
Meaning the market expects big price swings to continue.
That's exactly what it means. High uncertainty priced in.
So it really feels like there's this disconnect. Analysts lean positive, but the stock price and volatility suggest the market has some serious doubts.
I think that's fair. The market seems unconvinced about consistent execution, navigating competition, and getting to sustainable GAAP profitability. That's where the rubber meets the road and where the uncertainty lies.
Okay, let's move on then. Chapter 5. Ownership structure. Who actually owns Coursera stock?
Institutions are the big holders here. Somewhere between, say, 77% and maybe close to 81% of the shares are held by institutions.
Like big funds.
Exactly. Around 300 different institutions. Top names include BlackRock, NEA, the venture capital firm that was an early vanguard, Morgan Stanley, Bailey Gifford. Though it's worth noting, there have been some shifts reported recently. BlackRock apparently reduced their stake. Morgan Stanley increased theirs.
What about insiders, management, founders?
They hold a decent chunk, too. Maybe 6.5% to 7.0%, possibly higher if you count the VC firms closely affiliated. Dr. Andrew Ng is a key insider holder. Most recent insider sales look like they were just selling shares automatically to cover taxes on stock awards vesting.
Not necessarily a sign they're losing faith.
Probably not, based on those filings. We did see G Squared, another VC, buy shares around the IPO, and the former CEO, Meghan Calda, sold some shares later on. Overall, ownership is fairly concentrated among those top institutions and early investors insiders.
Got it. Now, let's look at how the company is governed. Chapter 5.2. Corporate governance. How's the board set up?
The board includes Chairman Dr. Ng and, importantly, a lead independent director, Scott Sandell from NEA. They have the standard committees you'd expect: audit, compensation, nominating, and governance.
Is the board independent from management?
A majority of the directors are independent according to NYSE rules, yes. And having that lead independent director provides independent oversight. They also say they consider diversity when nominating new board members.
How is executive pay decided? And what about shareholder rights generally?
Executive pay aims to link compensation salary, bonuses, stock awards to company performance and shareholder value. But as we noted, that stock-based compensation can impact GAAP results and dilute shareholders. Shareholder rights are pretty standard under Delaware law. Their annual meetings are virtual only right now.
And we have to come back to that public benefit corporation status and B Corp certification. How does that fit into governance?
It's central to their governance, really. As a PBC, their charter explicitly requires the board to balance shareholder interests with that public benefit mission, global access to education, and also consider other stakeholders. It's a legal requirement.
And the B Corp part?
That's like an external validation by B Lab, confirming they meet high standards for social and environmental practices, accountability, transparency. They have to get recertified every few years. It reinforces the PBC commitment and tells the world they're serious about more than just profits.
Okay, let's tackle Chapter 6, risk assessment. We have the SWOT analysis from the sources. Can you quickly summarize the strengths, weaknesses, opportunities, and threats?
Sure. Strengths: strong brand, big scale, high quality content from great partners. Weaknesses: that history of gap losses, slowing growth rate, reliance on partners. Opportunities: huge growing edtech market, potential in enterprise learning, leveraging AI, threats, intense competition, economic downturns hitting spending, complex regulations, execution risk with the new CEO.
That covers the basics. Now, there's been a lot of talk about these new U.S. tariffs imposed in 2025. How might those actually impact Coursera?
Yeah, that's a relevant question for a global company. The tariffs have a baseline rate, plus potential reciprocal ones. And this is really key for Coursera, the law used for these tariffs, i.e. EPA, has a specific exemption for information and informational materials,
Right.
meaning it strongly suggests Coursera's core digital offerings, the courses, the certificates are likely exempt from these direct tariffs.
Okay, that's significant. So probably no direct hit on their main business. But could there be indirect effects from trade tensions generally?
Yes, potentially. Indirect impacts are possible. Maybe slightly higher costs for hardware or infrastructure if sourced from tariffed countries. It could negatively impact partners, especially those maybe in China, affecting their ability to create content.
Or their enterprise clients?
Right. If enterprise clients are in industries hit hard by tariffs, they might cut back on training budgets. And just general geopolitical uncertainty or economic slowdowns from trade wars could make Coursera less affordable for international learners. So while direct risk seems minimal due to the exemption, these indirect effects are minor to moderate risks they need to watch. It highlights the general risk of regulatory volatility for global platforms.
Okay. Beyond tariffs, what are the other really key risks investors should keep in mind?
Well, definitely the intense competition we talked about. It's not getting any easier out there. Second, the path to sustained JAP profitability and positive ROIC, that remains a big question mark. Third, navigating that complex regulatory landscape, data privacy, accreditation, that's always a risk.
And economic factors.
Yeah, economic sensitivity. If consumer or business spending tightens, education budgets might get cut. Then there's execution risk. Can the new CEO deliver on the strategic shifts? Dependence on partners is another one. They need those universities and companies. And of course, cybersecurity is a constant threat for any big online platform.
Right. Okay, we've covered a massive amount of ground here. Let's try to wrap this up with Chapter 7. Brief conclusion. What are the main takeaways on Coursera as we see it in late April 2025?
It's definitely a mixed bag, isn't it? Coursera is clearly a leader in a significant growing market. They have real strengths, the brand, the partners, that strong balance sheet with lots of cash.
Yeah.
But they're in this tricky transition phase, shifting from just chasing growth to needing to prove they can be sustainably profitable on a GAAP basis. The market is clearly skeptical, as shown by the stock price.
So the valuation looks lower now, but is it cheap enough given the risks?
Exactly. The valuation multiples like forward PE or PS are lower than they have been historically. But the core investment question really hinges on your confidence in the new management's ability to execute. Can they deliver that sustained GAAP profit? Can they get ROIC positive? Can they do it while navigating fierce competition and upholding their PBC mission?
A lot of balls to keep in the air.
For sure. Given all those uncertainties, value investors would probably want a pretty significant margin of safety before jumping in right now.
That's a really clear summary. It feels like the journey of lifelong learning itself, much like a stock's path, often has these unexpected twists and turns. It makes me wonder, what's the fundamental lesson here from Coursera's situation about the future of education and investing in these kinds of innovative companies?
That's a great question to ponder as we wrap up. I think maybe the lesson is that the future for both education and investing in these disruptive platforms requires a really deep grasp of the fundamentals, and just a constant willingness to learn and adapt yourself as the world keeps changing so fast.
Absolutely. Well said. And on that note, if this deep dive into Coursera sparked your curiosity and you want to explore more in-depth analyses of publicly traded companies, definitely be sure to subscribe to the Stock Analytics AI YouTube channel.
And just the standard reminder, please remember that this analysis is based on information available as of April 27th, 2025, and it should not be taken as financial advice. Investing in the stock market involves risk, and you could lose money.
Right. This deep dive used publicly available information and AI tools to help synthesize and analyze it all.